Congressional Budget Office came out with figures earlier this month, is estimates for GDP and for the deficit. And what we're looking at, I mean, realistically, the deficit is going to be about 8% of GDP. They reckon that GDP will grow by 4.5%. Virtually all the deficit is spent into GDP. So what we're seeing is if you take the government spending out of GDP, the private sector is actually contracting in America. So this is actually, you do the same, the same sum with most of the other G7 nations. And you'll find that France in particular, bad news. Britain, bad news. Italy, bad news. I mean, this is everywhere where you've got these deficits, these nations are going into debt traps, and the biggest debt trap of all is the dollar debt trap, and it's that's going to unwind the entire credit bubble.
The global economy is standing on the precipice of an unprecedented financial crisis, and Alasdair Macleod, a highly regarded economist and head of research at Goldmoney, has been vocal about the dangers ahead. According to Macleod, the foundations of the global financial system are more fragile than ever, with years of reckless monetary policies, ballooning debt levels, and excessive reliance on fiat currencies creating an unsustainable bubble. Central banks, particularly in advanced economies, have perpetuated a cycle of easy money and low interest rates, fueling asset price inflation and creating the illusion of prosperity. But beneath the surface lies a dangerous reality: mounting debt that cannot be serviced, distorted market signals, and economies that are increasingly reliant on the continued printing of money to stay afloat. Macleod argues that these policies are not only unsustainable, but are also accelerating the approach of a catastrophic correction. Macleod has frequently highlighted the profound fragility within the global banking sector, which he argues is one of the weakest links in the current economic system. According to Macleod, the banking sector is particularly vulnerable due to a combination of excessive leverage, overexposure to government debt, and a reliance on artificially low interest rates to maintain solvency. This fragility, he contends, makes banks especially susceptible to systemic risks when economic conditions deteriorate or when confidence in fiat currencies erodes. When this bubble bursts, the consequences are expected to be far-reaching. The collapse could begin with a loss of confidence in fiat currencies, especially the US dollar, which has long been the backbone of the global financial system. As inflation spirals out of control, currency devaluation could erode purchasing power, leaving economies in turmoil. Financial markets, overly reliant on cheap credit, could experience sharp declines while global trade and investment flows are disrupted. In this video, we'll explore Alasdair Macleod's insights into the root causes of this looming crisis, how it could manifest across global economies, and what this means for governments, businesses, and individuals. Please watch, share, and like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
The bubble is really quite simple. You never have an even increase in the amount of credit in the economy. And, when things look sort of better, banks tend to increase their balance sheet leverage by creating loans, which creates credit in the economy. There comes a point where that gets a little dangerous, and then banks think, well, we've got too much risk on our balance sheet. And the two ways in which they can compensate for that, basically, are to lend money to the government rather than the private sector, and also to increase the rate, the interest rate, which they request private sector actors to pay. And that leads to, if you like, a turnaround in the economy. So, you have an economy which, is expanding, and then suddenly it starts contracting, as it were. Contracting in the sense that because credit is redirected towards government borrowing, you find that, the private sector ends up in trouble. Now, this is a cycle of bubbles which has been going on since the 1980s. And particularly, none of the bubbles have been allowed to wash out the malinvestments, the zombie companies, the companies which shouldn't survive because they don't actually produce what consumers want profitably. So those are the companies that should get wiped out every time the bubble bursts, as it were. But the bubbles haven't been allowed to burst. each bubble has fed into the successive one. So each bubble has got bigger and bigger and bigger. And we saw a very big bubble accumulate by the time 2008, 2009, which manifested itself in a property crisis. Um, that bubble was never allowed to burst. I mean, the Fed sat there with its checkbook and said, right, open check. Anyone who needs money, we'll give it to them. And it was followed by crises in Europe. You had Cyprus, you had Greece, you had, all these things started going horribly wrong. And again, the ECB said, whatever it takes. That was Mr. Draghi's mantra. So what we now have is we have the accumulation of all these bubbles into one big bubble. And the symptoms of it are really quite clear. I mean, you look at the valuation of equities on Wall Street. They're chasing the Magnificent Seven, the big tech stocks, on a momentum basis, not on a value basis. I mean, if value came into it, you'd be selling Tesla, for example. Donald Trump's turned around and said, I don't go for this climate change rubbish. We're withdrawing from the Paris Agreement. Furthermore, we're going to hit China with tariffs. Where are Tesla made? A lot of them are made in China. That market there is diminishing. That's a stock that should be sold under any normal value judgment. But instead, it's at an all-time high. I think it will be sold. Of course it will. But so you can see that's an evidence of a bubble. There's a bubble, if you like, in the equities. And certainly, given that bond yields have already risen, this means that the valuation basis for the equity market is now more stretched than it was in the dot-com bubble back in 2000. I mean, that's quite something when you think that the behavior of people in that dot-com bubble was absolutely extreme. That's one aspect. Another aspect is the cryptocurrency phenomenon. I mean, Bitcoin. They're going up forever. What are you buying? You're buying some digits. I mean, we had you could buy these sort of I can't remember what they were called, but it was sort of electronic art. It wasn't even that. I can't remember what they called them, but people were paying silly money for nothing, and that's a sign of excess credit. And this is why you have inflation in the system. I mean, by inflation, what we mean actually is a decline in the purchasing power of currency. And that's going to continue. So as to where we are in this bubble, I think we're on the verge of it beginning to collapse. I mean, I think it's topping out. What will make it collapse is the next rise in bond yields. At the moment, having had a bit of a rise, they're consolidating. They've come back a little bit. They will go higher again. And as they go higher, the whole of the credit, the gigantic credit system will come under threat. And the first thing we'll see is that there will be a massive bear market in equities. Lots and lots of money will be lost. And I think we'll also see cryptocurrencies come down as well, because crypto are correlating very nicely with the Magnificent Seven tech stocks. It's quite clear that the people who've been gambling in Bitcoin are the same people who gamble in those stocks. It's like a tech stock, if you like. So I think we're going to see that. That's going to be the first sign of it. But rising interest rates, rising bond yields are basically going to undo government finances big time, because governments, and particularly the United States, with a debt to, with a debt to GDP of around about 125, 130%. And the economy is not being productive. This is the other thing, Lucian. Congressional Budget Office came out with figures earlier this month, its estimates for GDP and for the deficit. What we're looking at, I mean, realistically, the deficit is going to be about 8% of GDP. They reckon that GDP will grow by 4.5%. Virtually all the deficit is spent into GDP. So what we're seeing is, if you take the government spending out of GDP, the private sector is actually contracting in America. So this is actually, you do the same sum with most of the other G7 nations, and you'll find that France in particular, bad news. Britain, bad news. Italy, bad news. I mean, this is everywhere where you've got these deficits, these nations are going into debt traps. And the biggest debt trap of all is the dollar debt trap. And it's that that's going to unwind the entire credit bubble.
Given his concerns about the fragility of the banking system, Macleod sees gold and silver as a form of financial insurance. Physical precious metals held outside the banking system are immune to counterparty risk, making them a reliable asset in times of crisis. Macleod is a staunch advocate for holding physical gold and silver as a means of protecting wealth in the face of this impending financial crisis. His argument is rooted in the intrinsic qualities of these precious metals as stable stores of value and their historical role as sound money. Macleod's recommendation aligns with the behavior of central banks, which have been quietly accumulating gold reserves at record levels in recent years, a move he sees as a signal of their own lack of confidence in fiat currencies. During his interview, Macleod suggests that these apex banks are not particularly concerned about gold and silver prices, unlike retail investors, but are more concerned about the current economic system and the rapidly growing fiat bubble. Let's get back to the interview.
I think the first thing to understand, and this is a point that actually the central banks understand, is that it's not going up. It's not gold going up. It's currencies going down. So that's the first thing and it's a very, very important distinction. The Bank of China, for example, you think it's buying gold. No, the emphasis is that it's selling dollars and it's selling euros. And other central banks are doing the same thing. I mean, they're not necessarily saying that the whole thing is going to fall apart. What they're saying is that there is now a greater risk in paper currencies, so we need to adjust our reserves accordingly. And so that's what they've been doing. There is also a geopolitical element in it because they can see that Russia and China have accumulated large quantities of gold. If you're a member of the Shanghai Cooperation Organization or an affiliate or an associate, dialogue partner, I think is the term as well, then, in various meetings, you will have discussed gold with, your opposite numbers. And I know pretty well, what the discussion is likely to be. It's likely to be, that the West, the dollar is toast over time. Anyway, we need to move away from the dollar because we don't want the American interference. That actually could be rather nasty for the dollar. So we need to have gold to protect our own currencies. So, the whole thing is there. And also, if you go back to the St. Petersburg International Financial Conference back in 22, this was after the West had stolen Russian reserves to the tune of over $300 million. Putin said quite clear, this is what these guys do to you. So don't have your eggs in the Western basket. Be as independent as you can. And furthermore, if you've got any gold stored in, with Western central banks in the Western alliance, you would be wise to get it out. So you can see that there is a far greater understanding of the role of gold in this current situation than there is, let us say, in Western financial markets. They're beginning to learn. And I mean, I'm looking at gold as we're talking. Today's the 22nd of January. Yeah. Gold price is 2,757. That's literally within $30 odd of the all-time high, which was back last early November. So, it looks like it's got enough momentum to go higher. But I mean, actually what's happening is that it's going lower. The dollar's going lower. Now, the reason the dollar's going lower is we've got a new president who's a spendthrift, and he's going to introduce tariffs against China and against the European Union in particular. The effect of that is that the consumer is going to have to pay higher prices. The consumer price index rises. What can the Fed do? Not a lot. It can't cut interest rates. And then you've got the budget deficit, which I think will be somewhere, it could be $2.5 trillion. And that's just inflation. That's debasement of the currency being injected into GDP. And non-Americans, foreigners holding dollars are watching this. And this is the assessment they're making. They can see that interest rates are going to have to rise. They can see that the US economy, while it appears on the surface to be growing, in fact, it's not productive. If anything, it's an inflationary form of growth. And the US is in a debt trap. And, Trump, he's not very much liked in Europe, except by, if you like, the people who are sort of anti-socialist, who are gathering, incidentally. I'm not saying that, what he's doing is all bad by any means, but on economics, I'm afraid that he's going to drive up the rate of inflation, which, put another way, is the purchasing power of the dollar going down. Who's going to want to buy the dollar? Who's going to want to fund government debt? I mean, at this rate, 5%? Well, it's 4.75% or something on the 10-year US Treasury. No, I don't think so. 5%? No, maybe not. You could be looking at 6-7%. And when it gets there, what happens to the arithmetic about the US government debt? Oh my God, it's getting worse and worse and worse. No, we just get out, don't get involved. And if anything, if we got dollars, get out and go and buy some real money with it.
What about silver? What will be the trigger for higher silver prices?
Well, I think it's more the commodity story that you brought up just a moment ago. I mean, it's interesting. Silver in the past has always been roughly twice as volatile as gold.
Yeah.
So we hang on to that sort of idea as silver bulls that gold, if gold breaks through this 2,800 level, let's say, then I think silver will be shooting off, because I think there comes a point where people look at it and they say gold's gone up, it's now going into new high ground, silver's been left behind, we got to buy silver. Yeah. So I think at that stage it rockets. It could be starting to rocket now. I mean, basically, it's kept pace with gold last year. I mean, they were both up about 25-26% or something like that. If I look at the gold-silver ratio at the moment, it's just under 90. I mean, that's crazy, absolutely crazy. On the industrial side, I mean, it's not priced as money. This is what that ratio is telling us. If it was priced as money, it would be under 20. Not priced as money. It's essentially an industrial commodity with, if you like, money sentiment in it. But it's been in deficit, according to the Silver Institute, for the last 4 years. So this is a commodity which the whole commodity whole commodity complex begins to move higher on the back of gold. I think silver will be leading the charge.
Gold and silver prices have experienced notable fluctuations this week, influenced by the inauguration of U.S. President Donald Trump and his proposed trade policies. Between January 20th and 22nd, 2025, gold and silver prices experienced notable fluctuations influenced by the inauguration of U.S. President Donald Trump and his proposed trade policies. On Inauguration Day, gold prices firmed as the dollar weakened ahead of President Trump's speech. Spot gold rose by 0.3% to $2,711.29 per ounce, while U.S. gold futures edged up 0.1% to $2,752.40. This uptick was attributed to investor anticipation of the new administration's policies, particularly concerning trade and inflation, which could influence future Federal Reserve rate decisions. The following day, gold prices surged even further, reaching a daily peak of $2,759.57 per ounce. This increase was driven by a weakening U.S. dollar and uncertainties surrounding President Trump's tariff plans. Although immediate tariffs were not imposed, the possibility of future tariffs, including a proposed 25% tariff on imports from Canada and Mexico starting February 1st, prompted investors to seek gold as a safe haven asset. On Inauguration Day, silver prices edged slightly higher, mirroring the upward trend in gold. Spot silver traded around $30.26 per ounce, reflecting a 0.2% gain from the previous trading day. The increase was attributed to a weakening U.S. dollar and cautious investor sentiment ahead of Trump's inaugural speech, which hinted at aggressive trade policies and a focus on American manufacturing. Like gold prices, silver climbed even further on Tuesday and Wednesday, hitting a monthly peak of $30.90 on January 22, 2025. President Trump's inauguration had a noticeable impact on gold and silver prices. His administration's early signals of protectionist trade policies, including potential tariffs, created uncertainties in global markets. This led to a depreciation of the U.S. dollar and increased demand for both precious metals as a hedge against market volatility. Silver also benefited from its dual role as a safe haven asset and an industrial commodity, as concerns over trade disruptions sparked interest in metals tied to manufacturing. While gold typically garners more attention during times of economic uncertainty, silver's strong performance during this period highlights its value as a complementary asset for investors seeking to protect their portfolios against currency devaluation and economic instability. Do you think this trend will continue to grow in the coming weeks and months? Please share your thoughts on how Trump's economic policies will affect the gold and silver markets. If you like this video and want more like this, please smash the like button, subscribe to the channel, and turn on the notifications bell for more videos. Thanks for watching.